Class number 3, Income Statements 101. While the balance sheet helps you know where you are and what you're worth, the income statement points you to how you got there and how you will continue to build value in the future. This class will cover some key concepts to help you understand how your credit union runs every day.
The income statement of a credit union is comprised of its revenue and its expenses. Therefore, accounts such as the allowance for loan loss would not be found on the income statement. That is a contra asset account and therefore would be on our balance sheet.
The common question would be, how does a credit union make money? When you look at the income statement, it's going to be divided into two areas to help you out. First, operating income, where we make money through lending or investing our members' money. Second, non-operating income. When you think non-operating income, the classic credit union thinks fees. So if you see the line item and it has fees attached, it's non-operating income.
Depreciation is the process whereby we take the cost of an asset and write it off over its estimated useful life. Therefore, it is spread across the period that the credit union will be getting the use out of the asset. Credit unions have the opportunity to incur interest expense in two different ways. The first way would be the interest expense on the shares that the member place on deposit with you. The second way would be the interest expense paid to another financial institution in the event that you have to borrow funds to increase your liquidity. The net interest income is the difference between interest earned on your loan portfolio and your investment portfolio and the interest paid to members on their shares and deposits. That income then is used to pay the operating expenses of the credit union. The allowance for loan and lease loss account on our balance sheet is a reserve against future loans that have the potential of not being repaid. The way we fund that contra account is by debiting or expensing to our provision for loan loss account on our income statement.
One of the key responsibilities of the board of directors is making sure that we haven't overstated our financial statements. We're not claiming more than we're likely to collect on behalf of our members. So each month with the income statement, one of the ways we do that is to back off the interest accrued or owed by our members who are more than 90 days delinquent. That way, in case we don't ever collect that money, it won't have been on the balance sheet or the income statement. The average person gets net income. Did you have more income than expenses? But when it comes to credit unions, we say it a little bit differently. It's the income earned minus our operating expenses.
Revenue sources for a credit union are comprised of income from investments, income from loans, and other service fees. Items such as salaries and wages would be an expense of the credit union and deducted from income.
Allowance for loan loss is not part of the income statement. Overdraft fees, delinquency fines, and loan origination fees are examples of non-operating income. Depreciation is the process of spreading the cost of assets, such as wear and tear on equipment, over multiple periods in which they are used. Interest expense is the money paid out to members for borrowing from other financial institutions and on savings and deposits. Net income is the difference between income earned on interest-bearing assets and interest paid on interest-bearing liabilities. The provision for loan loss account is used to fund the all contra asset account. Interest on loans that are past due greater than 90 days must be deducted from interest income. Net income is defined as the difference between income earned and total operating expenses. Salaries and benefits are not considered a revenue source for a credit union. Time to take the test. Good luck.